Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Government revenue, taxes and their types. Government revenue is a critical component of fiscal policy, serving as the financial backbone for the operations and functions of a state. Taxes, as one of the primary sources of government revenue, play a pivotal role in funding public goods and services, redistributing wealth, and influencing economic behavior. Understanding the various types of taxes and their implications is essential for mastering the fundamentals of fiscal policy. Taxes can be broadly classified into two categories: direct taxes and indirect taxes. Direct taxes are levied directly on individuals and organizations, and the burden of these taxes falls directly on the payer. Examples include income tax, corporate tax, and property tax. Indirect taxes, on the other hand, are levied on goods and services and are indirectly paid by consumers through higher prices. Examples of indirect taxes include value-added tax, sales tax, and excise duties. Income tax is a quintessential example of direct taxation and is typically progressive, meaning that the tax rate increases as income rises. This progressive nature helps in reducing income inequality by imposing a higher tax burden on those with greater ability to pay. According to the Internal Revenue Service, the United States employs a progressive tax system where the marginal tax rates range from 10% to 37%. This structure ensures that higher-income individuals contribute a larger share of their earnings to the government, which is then used to fund social programs, infrastructure, and other public services. Corporate tax is another form of direct tax imposed on the profits of corporations. The rationale behind corporate taxation is to ensure that businesses contribute to the public finances that support the economic environment in which they operate. The corporate tax rate varies significantly across countries, influencing business investment decisions and economic growth. For instance, the Tax Cuts and Jobs Act of 2017 in the United States reduced the federal corporate tax rate from 35% to 21%, aiming to stimulate business investment and economic expansion. Indirect taxes, such as value-added tax, sales tax, and excise duties, are embedded in the price of goods and services. VAT is a consumption tax levied at each stage of production and distribution, with the final burden falling on the consumer. It is a significant source of revenue for many countries. For example, the standard VAT rate in the European Union is around 20%. VAT is considered regressive because it takes a larger percentage of income from lower-income individuals who spend a higher proportion of their earnings on consumption. Sales tax is similar to VAT, but is only levied at the point of sale to the final consumer. The sales tax rate varies across jurisdictions and can significantly impact consumer behavior. In the United States, sales tax rates range from 0% in states like Delaware and Oregon to over 9% in states like California and Tennessee. Sales taxes are also regressive, disproportionately affecting lower-income households. Excise duties are taxes on specific goods, such as alcohol, tobacco, and fuel. These taxes are often used to discourage the consumption of harmful products and to generate revenue for public health initiatives. For instance, the federal excise tax on cigarettes in the United States is $1.01 per pack, and states impose additional taxes ranging from 17 cents to $4.50 per pack. Excise taxes can be an effective tool for reducing negative externalities associated with certain products, although they also tend to be regressive. One of the critical challenges in tax policy is balancing equity and efficiency. Equity refers to the fairness of the tax system, ensuring that taxpayers with greater ability to pay contribute more. Efficiency involves minimizing the economic distortions and administrative costs associated with taxation. Policymakers must carefully design tax systems to achieve these goals while generating sufficient revenue to fund government operations. Tax evasion and avoidance are significant issues that undermine the effectiveness of tax systems. Tax evasion involves illegal practices to avoid paying taxes, such as underreporting income or inflating deductions. Tax avoidance, while legal, involves exploiting loopholes and inconsistencies in tax laws to minimize tax liability. Both practices erode the tax base and shift the burden onto compliant taxpayers. The Organization for Economic Cooperation and Development estimates that tax evasion and avoidance cost governments worldwide hundreds of billions of dollars annually. To combat these challenges, governments implement various measures, such as stricter enforcement, international cooperation, and tax reforms. For example, the Base Erosion and Profit Shifting Initiative by the OECD aims to address tax avoidance by multinational corporations through comprehensive reforms of international tax rules. Similarly, the introduction of digital tax measures seeks to ensure that digital economy companies pay their fair share of taxes in the countries where they operate. In conclusion, taxes are a fundamental aspect of government revenue, essential for funding public goods and services, redistributing wealth, and influencing economic behavior. Direct taxes, such as income, corporate, and property taxes, directly impact taxpayers based on their earnings and assets. Indirect taxes, including VAT, sales tax, and excise duties, are embedded in the prices of goods and services and are ultimately borne by consumers. Policymakers face the challenge of designing tax systems that balance equity and efficiency while addressing tax evasion and avoidance. By understanding the various types of taxes and their implications, individuals can better comprehend the complexities of fiscal policy and its impact on the economy and society. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.